is our revenue account that is a credit by nature also going up, so it is credited. Increasing the revenue account to the correct amount and creating the accrued revenues asset account to represent that the business is owed money on balance day. So all of that discussion earlier in the lecture about creating temporary asset and liability accounts, this is what we're talking about here. Accrued revenues, unearned revenues, all of those accounts are temporary accounts that we use just for our balance day adjustments, so we can make sure that the records are correct, and then we can cancel everything out and start fresh for the next accounting period. Okay, so next up we're going to have a look at depreciation. We'll look at both straight line depreciation and diminishing balance depreciation. Both of those are listed in the syllabus that you need to be able to do for this unit. So to calculate straight line depreciation, you need three things. So you need the original cost of the asset, excluding GST, but including any necessary costs. And you want the estimated useful life and the residual value. So the useful life is how long it's likely to be useful for, how many years you're likely to have that asset for. The residual value is the value that you're likely to be able to sell that asset for when it reaches the end of its useful life. The original cost is just what you originally paid for it, excluding GST, but you also want to include any necessary costs. So necessary costs means things like like we saw earlier, we bought furniture in the example, but we also had that necessary cost of having the furniture delivered, so delivery expenses. And that's what we mean by necessary costs of purchasing the asset. So this is an example without necessary costs. So we've got a business that's purchasing furniture for $4,400, including GST, on the 1st of July. We've got our estimated life as 8 years. Our residual value is $600. And we have been told we're using the straight line method of depreciation, and we're to calculate annual depreciation. So keep in mind, it's going to change depending on the period that you're doing it for. Annual is what we've got in this case. So we're being asked to record the balance day adjustment general journal entry that would be made on the 30th of June each year for the duration of the asset's useful life to account for this depreciation. So straight line means that it's going to be the same amount every year. Just a straight line as in it's just standard, the same, the amount that it depreciates is not changing. So that's why the general journal entry will look the same every time, and we only need to use one here. So the first step, we've got this summarized calculation at the top. We're looking at the cost price, $4,400. You're getting rid of the GST, which is dividing by 11, $400. So we end up with 4,000. So a little bit more of an explanation there is available if you're not really sure. So the business paid 4,400, including GST. The original cost has to exclude GST. That's why we get rid of it. So we divide by 11 because is included. I stands for our 11. And then we get that 4,000 as a result. And step 2, we're just substituting our values into the straight line formula. So our formula we can see here, the three things that we said at the start we need for straight line depreciation. Our cost price, we've worked that out in step 1. Our useful life and our residual value we were given in the scenario question. So our annual depreciation is the original cost minus estimated residual value, and then you're dividing that figure by estimated life. So it ends up being 3,400 divided by 8, and that gets us $425 as our annual straight line depreciation. And we record that in our general journal with this entry. So we've got depreciation account for furniture going up, and we've got accumulated depreciation for furniture as our credit, and that happens each year on the 30th of June as our balance day adjustment to show that the value of that furniture is changing. And next up, we've got with necessary costs. So still straight line depreciation. So a different scenario here where we've got a motor vehicle that we've purchased for $22,000, including GST again. And we've also got this additional necessary cost, this payment of $1,100 in delivery expenses. So again, we've got that same information, our estimated life and our residual value are given to us. And we're going to do the same that we did before, recording our general journal entry for the 30th of June each year. And it's annual depreciation again as well. So we've got our step one where we're figuring out what our what our cost price is. So 22,000 was our original purchase price. We're subtracting the GST component, but then we're also adding our delivery expenses of 1,100, and then also subtracting the GST component from that of $100 as well. And that gives us a total figure of 21,000. So making sure that all GST is removed for both the purchase of the asset and any associated expenses as well. And whenever it says including GST is included, that is dividing by 11. And you can see again that little explanation if you need a little bit more help with what that is. So, and again, that is a little bit more explanation. So if you need to look through this in more depth, I would recommend going through this and looking at the full explanation if you're struggling. So then again, we've got the 3 different components we need. We worked out that we needed 21,000 as our cost price in step 1. And then we've got our useful life of 10 years and our residual value of 2,000. And then it's just a matter of putting this again into our formula, and we're getting $1,900 as our annual straight line depreciation with the necessary costs included. So it's that same thing again with 1,900 as our amount. So the difference here is just adding the necessary cost in our calculation of the cost of the purchase, and also subtracting the GST from those necessary costs as well.